Well, joining me now to talk more about the markets and about some of those financials is Riverfront Investment Group's Chief Equity Officer, Doug Sandler. Doug, thanks so much for joining us again. Now, before I get to financials, I want to talk to you about retailers because I just had Paul Hickey on from Bespoke Investment Group who says, look, I would buy on some weakness in retailers. In fact, he thinks that now is the time to get into them because they're going to start to outperform or break out in the beginning of next year. Is that something you agree with?
Yeah, I'd say the whole retail group isn't one of our favorite groups, but it is a group that we are slightly overweight. So I think you got to pick your spots. I think Sears Holdings is a great example of, it's company specific, and it always is with retail. There will always be winners, there will always be losers, and it is somewhat a zero-sum game. If we look at our portfolios, I think there's always a place for the premium retailers. So a Nordstroms or a Tiffany's would be groups that or companies that we like a lot, simply because that high-end consumer, people with jobs right now, actually are doing pretty well and probably richer than they have been at really any other time in the past because expenses like credit, house costs, et cetera, are so low. On the other hand, we also like the really low end of the market. So companies like Dollar Tree and Family Dollar, we in our view believe that there's a secular trend of people that haven't just shifted down because of the economy, but have made a permanent shift in their shopping habits. So we own those as well. And I think Walmart at 12 times earnings, here's a company that nobody's better as an efficient deliverer of goods. And that's a company that's finally starting to turn after 10 years. We haven't owned that stock for really 10 years, and finally it's starting to turn. And
so finally you're starting to put some money into Walmart then?
Yeah.
Okay. What is your big bet then, Doug? Where are you going to stick your neck out in 2012? Where is it?
Yeah, I'd say our bets aren't so much sector specific. I don't think this is the kind of market where sector calls make a big difference. I think it's more on the cap. So we like large caps. And I think it's on the sort of the quality or the dividend story. So large cap dividend growers, and you can see that.
But that's the same as 2011, Doug.
Sometimes these trends, last for a while. And actually, I would have probably told you the same thing in 2009, and it wouldn't have worked in 2009. So, it's a 4 or 5 year trend of underperformance. If you've owned companies like General Electric or Walmart, or some of these Pfizers or Mercks that have done nothing for 10 years, they're finally starting to turn. And I think 2011 may have been the first year where you've actually had that turn. And it's because they've grown into their valuations. It's because investors have signaled that they're now ready to give these companies a second chance. And as a result, you're seeing relative strength. And those trends don't last just 12 months.
Right.
They tend to last for a while. So we're going to stay on that train until it stops. And I think there's still a long way to go if you just purely look at valuation.
So then does that mean the financials, do they get left behind or do they join?
I think you're starting to see specific financials join. So I think the really big banks, unfortunately, I think there's just a ceiling on their head. And if you kind of think of, I tried to make the analogy of the AT&T breakup, that when AT&T got broken up, the actual companies that came out of AT&T didn't do so poorly. They kept up with the market. What really did well was all the companies around AT&T that grabbed the areas of the market that AT&T could no longer compete in. I think today's big banks have a ceiling on their head. They can't grow the way they used to grow. They can't be in investment management. They can't be doing all the other things they used to do.
So you don't want to buy those then?
No, but it's created a vacuum for other companies that can offer those services. And I think that's where the growth is. So we own companies like American Express. We like some of the regional banks like PNC Bank Corp. I think some of the asset managers, we own Invesco. I think there's some other great ones out there. But those are the kind of periphery opportunities.
Just quickly before I let you go, Doug, what about technology companies, though? I mean, talking about growing into their valuations. What about some of these IPOs coming up next year?
The IPOs, we don't play in that market typically, but I think some of the really great big tech stocks, Apple you mentioned, IBM's another one, Qualcomm, great companies that I think are cheap enough and have really good growth, and pound for pound are probably some of the best opportunities in the market today.
Okay, but what about those that have IPO, those that have listed? I'm talking about the LinkedIns and the Groupons and the Zynga that just launched. I mean, does that fit into your portfolio anywhere?
No. I'll leave those for gamblers, not really our expertise.
Okay, all right. Doug, good to talk with
Ben.
you. Have a great new year. Doug Sandler
Yeah, thanks.
of Riverfront Investments.